like this. But thank you very much for joining us this afternoon on this beautiful sunny afternoon where, for once, I'm actually enjoying air conditioning. I popped outside earlier, it was baking. So I'm rather glad to be here, really. So I'm Julia Dreblow. I'm hosting this session for the next hour. And my area is sustainable investment. I've worked in it in its various different guises, mostly since 91, but full-time since 96. So I've done that area quite a lot, and the reason I got involved in it was because I realised that where money goes is absolutely vital, and quite a lot of us actually care what happens to the planet. So why wouldn't you use investment to be a force for good and to delight clients while we're at it? But making that happen is not going to be straightforward. I mean, as I say, it's seen me pretty much throughout my career. And what we really need is a very rich tapestry of people who are using the various different levers and making different bits of the system work so that we can actually direct that capital without there being chinks in the chain that stop it all from working and fall to bits. Now, my area is retail investment funds, which is listed equities, etc., and financial advisors and wealth managers. But we've got other people here on the panel from very different areas, and I'm going to perhaps struggle to remember everyone's names, but I do know Randeep. So Randeep, if I can ask you to introduce yourself for about 1 minute each, perhaps, if we can, please.
Sure. Thank you very much, Julia, and welcome everyone, and thank you for joining this panel. So my name is Randeep Somal. I work for M&G Investments, and I'm part of the team that manages our Paris-aligned sustain strategies, both global and European. So we look for quality companies that we can invest in over a long period of time, most importantly, understanding companies that are decarbonising and have an aim to reach net zero and working with them in order to get to that end target.
Thank you. Dan, please.
Hi everyone, my name's Dan. I help to run a business called Fintel that provides regulatory services, business processes and financial technology to financial advisors, and also services to product manufacturers, the likes of Randeep, who want their funds or their pensions, etc., to be used by financial advisors for those end consumers. So our job is to connect the market so that the end consumer makes a better informed decision and gets a better outcome as a consequence.
Thank you. Irina?
Hi everyone, it is really great to be here. I am the managing director at Ara Partners. Ara Partners is a global private equity firm. We are at 6.2 billion in assets under management, and we invest in industrial decarbonization. We typically define this rather broadly, so we target 4 core sectors: manufacturing and services, chemicals and materials, energy efficiency and green fuels, as well as sustainable food and agriculture. And we try to set a target at 60% of greenhouse gas emissions for every investment we make. And this is assessed or ascertained at product or service level compared to a market incumbent.
Thank you. And Duncan?
Yeah, they've got, I think, a very different background. As it says on the board, I'm a chartered environmentalist and fellow of IEMA. I've been an environmental professional for about 30 years now, which means that I started COP15 in Rio. Since when we've put up as much greenhouse gases into the atmosphere as in the whole of human history before then, and destroyed about half of the biosphere at the same time, cheery thought. So a few years ago I realised that obviously what I was doing wasn't working. I took a position with an internet startup called Spherix, which was doing automated carbon accounting, which a couple of years back was bought by Sage. So now doing the same thing within Sage, which obviously has 3 million odd customers worldwide.
Please, Mark.
Thanks, Julian. Hi, everyone. Good afternoon. Thanks for joining this panel session. My name is Mark Moser. I'm the head of impact at Lightrock. I'm overseeing our impact and ESG practices globally. I've been an impact investor for about 15 years. Lightrock is a private equity impact investing platform with a focus on providing growth capital. We do invest heavily into climate solutions, but not only, also beyond that into social impact companies as well as other environmental impact companies. We manage a portfolio of roughly 100 portfolio companies globally, a very diverse set of companies that we're working with, and assets under management of about $5 billion US dollars at the moment. We manage SFDR Article 9 funds, so part of my responsibility is to also manage and work quite intensively on regulatory conform ESG reporting that obviously includes climate and carbon emissions as well. So it's a dual mission almost to say for me, actually first backing climate solutions as well as making sure that our entire portfolio is actually reducing carbon emissions.
Fantastic. I'm going to start your end now, Mark, and come back this way if I may, if that's okay. If we could just say in maybe a few sentences each, what actual problem are you trying to solve? Really, what's your service for? What are you solving?
So our mission is actually to back really very ambitious entrepreneurs solving the world's most pressing sustainability challenges. And that actually across a wide set of outcomes that we're trying to achieve through our investments. Across 7 verticals, so to say. That also, as I said, includes climate solutions, but also goes into healthcare, education, urban smart transportation, sustainable agriculture, financial services, and also increasingly more into, for example, cybersecurity and protecting the digital realm. So it's a diverse set of outcomes that we hope to deliver through our investments.
Brilliant, thank you. Duncan.
It's similarly very diverse, but if I could just whittle it down to one, 99+% of businesses are small businesses. They're responsible for over 50% of business emissions. So you can't achieve net zero without dealing with that. But small businesses tend to lack the resources to do carbon footprinting, net zero transition plans, this sort of thing. So what we do at Sage Earth is to use what data they already have, like accounting data, banking data, that's already been curated, already been reconciled, and we use that to automate carbon accounting so that we can generate carbon footprints automatically for small business.
So is that helping them to understand what they're doing so that they can take action? How does that work?
Yes, helping them to understand so that they can then have targeted decarbonisation actions and green lending on those actions, and also so that they can feed that information back up the supply chain down the supply chain to their customers who need it. So typically if you have a large real estate company which might have 98% of their emissions in their supply chain, but all of their suppliers are small businesses, that's a good solution.
Fantastic, thank you. Irina?
I think from our perspective, we seek for collinearity between investment return and decarbonization. So we don't see this as some sort of separate item. So we focus on return, and we're focused on delivering an attractive above-market return to our investors. And we're doing that through decarbonization of the industrial economy. If we think about climate action, majority of the investment typically has gone to VC or infrastructure financing, typically focused on wind, solar, so scaling the renewable energy technologies, which are very much needed. But our focus is on 60% of the rest of the economy, which is the industrial economy. And we typically identify impactful investments that can help to decarbonize the economy of made things or the molecule rather than decarbonizing the electron.
Right, so that's a transition play, effectively, is it?
It is not a transition play. Transition play is typically brown to green. We define industrial decarbonization broadly. So, for example, a magnets business that supplies soft and hard magnets for EV rotors and solar inverter systems, or biofuels business that supplies fuels to the shipping industry, etc. This would be industrial decarbonization for us.
Ooh, thank you. And Dan, the problems you're looking to solve, obviously it's a part of your business, but talk to...
Yeah, can I try and frame both the opportunity and the challenge through some audience participation?
Oh, except the opportunity is the next question, but yes.
Well, let's go with the challenge then. How many of you who are listening, if you are listening, how many of you have got a pension? I mean, I guess nearly most of you, or ISAs, let's go with ISAs as well as an investment. How many of you, and you're going to be a fairly well clued up audience on this, how many of you would know how to invest the money that's in your pension or your ISA in a way that achieves your particular view of ESG and sustainability and governance? Less of you. And how many of you wouldn't have a clue what was inside your pension? Not even a fair few from there. So we look after about a third of the UK's financial advisors. and collectively they advise on over 50 billion of recommendations a year of everyday people's pensions and ISAs. And of that 50 billion, about 4% goes into what I would call sustainable, ethical and governance funds. That's the scale of the challenge that we're attempting to overcome, because they've got to deal with what do you want, what does the fund manager actually do, and how do they connect the two things up at the same time as the regulator, the Financial Services Authority, Financial Conduct Authority, is telling them you've got to make sure it's suitable for what your customer does. So that's the scale of the challenge in the financial services industry.
One that I'm very familiar with, having spent my career focused on that area. Yeah, it's a massive challenge and so important. This stuff has to get through to end clients. But that brings us to Randeep, please.
Thank you, Julia. I mean, actually, to be quite frank, just following on from what Dan just said, when we look to invest long term, when you're investing in your pension funds, 20, 30-year window in some cases, you want to mitigate as much risk as you can and maximize the absolute return. Now, we believe that decarbonisation, or companies that specifically do not decarbonise, are opening themselves to huge risks. Regulatory risks, financial risks, societal risk in terms of how those businesses are managed. So hence, we have Paris aligned, and we were the first to Paris align our portfolios to show that there are a wide enough companies out there globally and across sectors that we can invest in that are taking this seriously, and we have mitigated yet another risk in doing that. And we can also work with those companies in helping them decarbonise, monitoring their journey, and making sure that we as investors have ensured that that risk isn't an issue going forward, and in a lot of cases is actually an opportunity.
Indeed, the word risk isn't used often enough in this area. The size of the risk clearly is immense, hence the need for so many different types of businesses, some investors, some enablers. And that's why this panel is so exciting to do, that we start to recognise that the depth and breadth of infrastructure, if you like, that's going to be required just to switch financial services from where it is today to where it needs to be in future. So just to add also, I'd like this to be interactive. Dan stole my thunder a little bit on that, but hey, we're good. Please ask questions. We've done a little introduction to everybody and why we're all involved, which is super important. Can I just ask you if there are any immediate questions right now, or would I just say it's quite dark, so it might be hard to see, but please do just wave at me as we go through. Are there any questions right now? No, okay, we'll shift forwards. Okay, so that brings me on to the next bit then, which is around the challenges and we'll look at challenge and we'll look at risk, we'll look at opportunities separately, but the challenges you face, none of this is easy. I mean, goodness knows this area has nearly wiped me out enough times. So for starting off with the challenges that we faced, I think I said I'd ask Irina first, if I may. Can you tell me a little bit more about your market? And what's been hard? What's slowed it down? What have you had to deal with?
I think in my space, the core challenge stems from the type of investments that we make. So if you think about net zero investing, typically you have large corporates, sometimes listed equities with data publicly available in the market, and you are focusing on transitioning that corporate down the net zero journey. When you often invest in climate solutions, these are scaling businesses, maybe with the first operating facility, offtake agreement, but typically there is very limited data available. They have not done their footprint, as just my colleague had mentioned. And so from our perspective, we have focused on developing a data set that is meaningful for climate solutions, not just large businesses. And we have solved this through collaborating with a coalition of investors, which currently has around 900 observers, 370 members, 700 trillion in AUM. And specifically, we focus on estimating the emissions reduction potential of a climate solution at the product and service level, and projecting this on a forward-looking timeline, as well as estimating that impact at the investment diligence phase. So
that sounds really easy.
Not so easy, in fact. There's a lot of thinking is being done in the industry. And so I think that as more data is being developed on climate solutions, we'll increasingly see more transparency.
Yeah, and joking apart, that's really tough, getting those kind of numbers of people to do things together. So brilliant, fantastic. Next question, I was going to come to Duncan for the same kind of subject around the challenges that you faced over time. I mean, we've got an awful lot to go at here, but data quality, perhaps. What are your biggest challenges you faced?
Yeah, absolutely. Sage is predominantly an accounting company, and we call what I do carbon accounting. You can see it says on the back of my T-shirt. And nobody has so far come up to me in the street and asked me about carbon accounting. But accounting
has been a massive challenge.
Accounting has been around for centuries, and you can reconcile to the nearest penny. There are established rules and guidelines, and you go to jail if you don't follow them. Carbon accounting, no. If you do a carbon footprint and somebody else does a carbon footprint on the same company and they come in within a factor of 2, that's pretty good. It's pretty accurate. So on the one hand you've got that. On the other hand you've got carbon emissions are now like commercially material. So things like PPN 0621, you have to do carbon reduction plans for tenders, and large companies are choosing small companies to do their work on the basis of the carbon intensity of those suppliers. So it does become material. So what we're trying to do, the only way you can resolve that is by specificity and having as much primary data as you possibly can in your carbon footprint, whilst of course making it seamless to actually generate it, not requiring any kind of expertise. So it's quite a tricky challenge, but that's what we're working on.
Yeah, I'm married to an accountant, that's bad enough. Carbon accounting on top of that, yeah. I mean, not that ICAW isn't doing lots of courses on it, they are, because I see them doing them, but this is a challenge, this is hard stuff, and hopefully internationally we'll come together under ISSB, etc. We're heading that way, but presumably that's something you're familiar with and aware of.
Yeah, absolutely, but it's also, even underlying all of the standards at the moment is a lot of generic data. And there's this issue that if you say you have 2 electricians in on your books, you do your carbon footprint, both of those will come up as electricians, they'll both attract the same emissions factor. The only way you can reduce your emissions, if that's how you're doing your carbon footprint, is to reduce your spend, which no business wants to do. What you need to do, if you actually want to decarbonise, you need to know the individual carbon footprints of each of those suppliers. Then you can choose to push business towards the low carbon one.
Yeah, and you've got to go so fast. Yeah. Dan, financial advisors, they're dead easy too, right? Would you like to talk to some of the challenges that we've had in that market?
It's interesting, both Irina and Duncan have just highlighted the challenge that just gets exacerbated down the line as you go from a company being available for people to invest in it, and on the far side an end consumer who's got a pension or an ISA and wants to put some money into something, and all the steps along the way that has to go on. So imagine, let's say, this is me thinking out loud, so this may not work at all, but let's say that all the people on the far left, as I'm looking at it, of the audience over here, are companies, and there's hundreds and hundreds of thousands of them in the UK and millions around the world, and they're all over there saying, come and put your money in with us, please, and look, we've come up with this way of showing our accounts, of which Duncan points out it's all standardised for the usual stuff, but not for this. And then all the way over here at the far side, all of you guys, you're the end consumers with your pensions and your ISAs. But, chap at the back might be thinking, I believe this type of thing about climate science and carbonisation would be good. And that's similar to somebody next to them, but actually they'd quite like to see greater female representation on boards at the same time, and they don't want to see any arms in their portfolio whatsoever, or any tobacco products. So everybody's over here is going to have their very different version of that. And in the middle, you've got some fund managers down this part who are going to pool together these companies as something that you can buy based on all of these criteria, using their criteria of what the correct things to choose here are. And then right down here, you've got financial intermediaries, the financial advisors, who've got to take the opinions and the wants and the needs of those customers, work out which of these funds is using the best methodology to work out which of those companies is right for that person to put in their pension. And all the while, whilst that's happening, all of this information asymmetry and difficulty that you've heard about here is happening. And to top it all off, if you're a financial advisor, you've got the regulator saying, if you discuss all of this with these clients and then get it wrong, it's your fault. So we're going to make you pay money every time you do business, and the more business you do, you're going to pay more money into the pot in case one of your fellow IFAs gets it wrong, and then we're going to cover all of the wrong fees from all of that. So that's the challenge that the intermediaries have in this space when it comes to dealing with all of this information asymmetry that you're hearing about here.
That was so motivational, Dan. Thank you. I hope you're all getting a flavour of the challenges. I mean, anyone who thinks we can get one metric, one solvent, flick a switch somewhere, job done, this, hopefully, is all the evidence you need to know it ain't going to work like that. You know, there is a lot going on. And perhaps if I can come to Mark next, please.
Yeah, maybe just to add on what has already been said. I mean, obviously, data availability, data quality, data accuracy is a huge problem. It's probably the biggest problem we're facing, and that's speaking from representing a global portfolio of companies everywhere in the range of 50 employees up to 2,000 employees, where we see actually the full spectrum of sophistication and maturity or lack thereof. So from independent audited carbon inventories all the way through to no clue about their carbon emissions. Maybe speaking of a small company in India that is purely digital. So managing that at the portfolio level is a huge challenge, and it's really about deriving the right conclusions from the data that you get, and maybe also leveraging third-party estimates and modeled values for just informing strategies, and then really engaging efficiently. And it's really a resource allocation and deployment question. How much time and resources shall we kind of deploy for engaging with which companies? So deriving and holistically tackling decarbonization at the global large portfolio with such a diversity of companies is indeed a big challenge. And we only just started, so to say, a few years ago, and we can obviously leverage whatever is out there, but it's still a big challenge actually to make that to manage that efficiently.
Yeah. Seriously so. Randy, please.
Well, I'm not going to say anything different. So data, of course, is the issue that we come across in, or gaps in data. The integrity of data becomes very difficult when it comes to carbon, especially companies reporting GHG. But let me maybe side a little bit on the positive side. So we have the GHG protocol now that companies tend to follow. So that is trying to put in some uniform standards globally in terms of how best practice companies should report. Third-party auditing now, pretty much all the big audit firms have the capacity to verify and audit greenhouse gas emissions data. It's still on a voluntary basis, but this year we've seen the EU put in place the Corporate Sustainability Reporting Directive that starts off in the EU but instructs companies now to report Scope 1, 2 and 3 emissions, and also have plans in place to reduce those emissions. More and more companies will come in the scope of CSRD, and by 2027 and 2027-8, it will start incorporating companies outside of the EU that do more than 150 million euros of business within the EU. So we're starting to see uniform standards come in and a regulatory requirement for companies to report data and also have that audited and verified much in the same way they do their financial data. Now, it's not going to happen overnight, but the direction of travel is positive.
Thank you, which is seamlessly leading us into the next question. I'm going to go down my list here just so I don't get confused, but thank you. That I will come back to you on regulation a little bit more. Perhaps if I can touch with Dan. I just want you to be quick on this because I don't want this to be a session on regulation, really, but there is a lot of relevant regulation. So I want you to all have the sense of the depth and breadth of rule changes that have been needed. So perhaps if I can ask Dan to kick off.
Well, we've touched on this, that underpinning everything, irrespective of anything to do with carbon or to do with the environment and other such considerations, is that if you're operating in retail financial services, you are absolutely beholden to suitability rules, as they're known. So the financial regulator will hold the feet to the flame of all of the fund managers, but all of the financial advisors as well, to try and make sure that there's a golden thread of truth running from the financial product through to the assessment of need and on to the client. And that's the intention.
But FCA.
Through the FCA. But in amongst all of that is a whole mass of, some might say nonsense, I wouldn't, that gets in, possibly say that. but of difficulty and huge granular detail that's required. Now, then you delve in specifically into the area of sustainable investing and carbon impact, etc. And there is a move at the moment, it's probably been discussed at several sessions throughout the day, to bring in new rules and labels that make it easier for people to understand, to say that this is an impact fund that's going to do this specific type of impact, or this is an improving fund that's going to work on turning bad companies into good companies from a carbon perspective, that to try and give some simplicity to the end consumer. So on top of that regulatory challenge, though, what I would add is there's still a demand challenge. And I told you earlier that there was, in our world, over 50 billion of recommendations a year, and a tiny fraction of that, about 5-6% at the moment, goes into these types of funds. About 2 years ago, that peaked at a massive 8%. And that was because those funds were all performing really well, just because of the way the markets operated. And then that performance waned, and consumer interest waned with it back down to that averaged out level. So there is also a challenge on the end consumers demanding enough of this to make the rest of the infrastructure end up flowing towards it. And what's happening now is, from a regulatory point of view, kind of an attempt to solve the plumbing so that when the demand comes, everything can flow through correctly. But it'll all be in vain if we don't get the demand at the end of it.
And as Dan knows, I've spent a huge part of the last 5 years working on all of that and trying to make it all work and make it so it works for financial advisors and end clients. Because if it doesn't make sense, if we don't use the kind of language that someone like yourselves with a pension or an ISA or just regular investors can understand, then it fails, because you start getting into territory where you're confusing people, and which is borderline greenwash, if not intentionally misleading people. So we need to straighten all that out, which is a massive thing. So that's the SDR rules, which have gone live November last year, which are gradually working their way through and building up as time goes along. Perhaps, Randy, you touched on regulation a moment ago, but are there other... You talked about the big macro rules. Some of that's really useful. I don't know if there's anything more you wanted to add to that, or...
I mean, a couple of things. So these rules now are coming in place, which helps us greatly as investors. I mean, if you look across the different geographies, Europe, and I include the UK in that, are clearly at the forefront of it. You see that the US is catching up, and Asia is probably a little bit behind further from that. But if you're investing in high-quality companies, you know, they understand the needs of this before the regulation. They're already one step ahead of it. You look at the large US tech companies that everyone pretty much aspires towards and look towards. You know, they have been doing this for a very, very long time. And I think as long as they're setting the standard or the barometer of what a high-quality good investment effectively looks like, it brings in the rest of the companies regardless of industries.
Thank you. So I think I was going to come to Irina next, if I may. So rules from your perspective, SDR probably isn't quite so relevant, SFDR maybe?
So our partners is based in the United States. United States does not have similar regulation. However, if you market your instrument in the European market, that of course applies to your instrument. We're Article 9 fund, which has very high rigor in terms of the types of investments that we make. We certainly welcome the regulation and would like to see the same in US. But I think what I would like to highlight is a far more impactful thing, which is regulation that incentivizes the demand for the products of the businesses that we're trying to scale. So, there is a huge focus right now, say, on hydrogen. However, if there isn't demand, there isn't an investment, right? So investment tax credits that incentivize offtakes in different sectors, for example, European mandate on biofuels or European target, targets on sustainable aviation fuel, targets on recycled plastic content, and deposit schemes. So anything that incentivizes demand for clean technology solutions is very effective. And of course, in the US, the IRA, the Inflation Reduction Act, has been extremely effective at catalyzing additional follow-on investment. So to give you a specific example, our portfolio company, Vacuum Schmelze, which is building soft and hard magnets, it is a business that is one of a kind Western producer of this type of magnet that goes into EV rotor systems, has received $111 million in tax credits, which is a tax equity that can be sold. We don't underwrite for government incentives. However, if it is available, it is always helpful. And the impact of IRA, I think, will be something that European market is still reacting to.
So not so much regulation, but stimulating the market in order to get the response, which is kind of what we all need, right? Duncan, if I can come on to you next. I'm no expert in your area, so please, you're going to have to go this alone.
Yeah, no, you are. There is no regulation in my area at all. I'm actually very encouraged to hear how enthusiastic, I suppose, maybe that's not quite the right word, but how not hostile everybody has been about CSRD, and there's at least a good spoonful of alphabetic spaghetti of acronyms flowing around. And we do this at Sage Corporate. Obviously, we comply with things like CSRD, and it's a colossal burden. It's absolutely enormous, and that's across every business. Not every business, all the large businesses have to do that. But from my perspective, it's really because, as Dan was saying earlier, at the moment, if you want to invest your pension, it's very difficult to understand where your money's actually going. Personally, I took all my pension money out and invested it myself because I understand the environmental bit and the investment bit I was prepared to take a gamble on. But at least that way I know which companies I'm directly investing in. And the way I see the regulation here is that we've known about all these sustainability issues for 30, 40 years, but we've done nothing about it. We're now absolutely yanking on the handbrake, and that's really tough. But that's just because nobody listened to me for the last 30, 40 years.
You're not alone in that club. We can have a mutual appreciation to add to it. It's been tough, right, to have people laugh and just think it's ridiculous for such a long time when it's so blindingly obvious, vital.
Yeah, and you couldn't, literally, there's no pleasure whatsoever in saying I told you so.
No, there isn't. It's just deeply upsetting, frankly. Best cut off that one, I guess. So who haven't I come to? Mark, I haven't come to you on this question. Let's talk about regulation. What are the key bits of regulation that are relevant to you, and how useful are they? Are they working? Will they help accelerate things?
Yeah, so our funds are based in Luxembourg, so that means we are fully exposed to SFDR. It's Article 9 funds as well. So obviously we need to kind of report on all the principal adverse impact indicators, etc. It's not new to us, right? It's something we've done actually for a long time. So it just needed a little bit of reframing, recalibration, restructuring of what we did before in terms of, we called it unintended negative consequence impacts that we always managed. So that's not new. But it needed a bit of effort and work. And I think it's helpful. It's valuable, right? It's a high degree of standardization, which, for example, practically speaking, means actually we can join forces with other investors in our companies, co-investors, who are also Article 9, and we have exactly the same identical reporting requirements. That actually eases the life for the companies, so we can do that. And obviously we have templates now alongside which we need to report to our clients. Whether our clients have the capacity to really understand in full detail what we're reporting, I think that's one question. But I think it's going in the right direction, and obviously I think this regulation has not been made for us as impact investors, intentional impact investors, but obviously we need to adhere to it and show best practices. So we can actually step up and show what we've been doing for a long time and really kind of show what market practice is on that. So I think it's an opportunity for us to really do a good job there. Yeah,
and certainly one of the things that's upset me over the years is the way that Europe and the UK went separate ways. Because I was involved in this back in the day, 2010-ish, when we were all together talking about this stuff. We would have had one regime, and the UK was being a lot more pragmatic and general and high level and thinking about clients, and the other European countries were always more techie focused, and hopefully what we will see is some convergence so that will make it easier for you guys going forwards. I think that would certainly be constructive and positive. So that brings me on to Actually, everyone's been remarkably positive anyway, which is fantastic because there is lots of good stuff happening, right? We're actually getting some rules in place that make sense. The people actually tend to agree with them, and that hopefully they will help stimulate and deliver demand, which will help leaders to lead and become more profitable and successful and deliver returns, and it will become self-fulfilling. That's the general idea. But can I ask you each to maybe talk around an example, whether it's a fund, a product, a company, or a service, whatever you do, to just bring this to life for people, to give real life examples. So perhaps Paris Aligned, I think we touched on previously, but if you want to go off-piste, it's absolutely fine, Randy.
Yeah, no, I can absolutely talk about the products. I mean, if we think about it, so these also are Article 9 funds. So what we're trying to do is have an impact with the companies that we're investing in, making sure that they're decarbonising, making sure that the risks are mitigated, but we also set aside a part of the portfolio for climate solutions companies as well. So companies are actually providing the tools, the products, the solutions for their customers in order to decarbonise. So we see that also as a huge growth area between now and 2050 and effectively beyond. And more companies globally now are falling into our sphere of being Paris aligned. So quality companies thinking about the longer term, investing today, and really differentiating themselves from companies that are not doing this. So you see that differentiation along the lines of competitiveness, the risk of regulation completely going away, and it gives you a better mindset of being able to invest now, not knowing that those risks are embedded in the business model going forward.
And from a portfolio perspective, I mean, are there good and bad ways of doing it?
I mean, from a portfolio perspective, you can get a cross-section across industries. So, you can mitigate the risk in that respect. They're not all solely focused on one area or another, or all solely focused on one country or another either. So you can build a broad global portfolio mitigating any sort of industry or country-specific risks now, because more and more companies are falling into this universe. Because that was the main concern, that you would actually encumber the universe in order to invest this way. We found that you don't. The universe is broad enough, and yet you've also mitigated another risk.
Thank you. And then following down the chain of the same line of thought and taking this to the advisor side?
Well, in terms of things that are happening that work and that are good and that are being developed on. First of all, let me try and inspire the audience to take an action themselves if I can. You've all been sitting there quietly for quite a while, so a bit more audience interaction for you, if you will. Can you put your right foot out for me, those of you who can? Put it out straight. And just spin your foot round clockwise. Make sure you're going clockwise. Have a think. Go clockwise. And now draw a big 6 in the air in front of you. Quick, draw a big 6. The vast majority of your foot just went round the other way, and I can see the smiles on some people's faces telling me that their foot instinctively ended up going the other way around. That is why you need a good financial advisor. Because every now and then your brain makes decisions that were based on wrong information and that you shouldn't have done. And if you do work with a really good financial advisor, the types of things that are happening in this market now and this world are that instead of them just talking to you about risk being about how much your portfolio might go up or down by, oh, you don't like that, okay, well, we'll narrow it and make it, could go up by less but down by less. They'll now talk to you about what are the types of things that you do or don't want to invest in. What are the things that fit your ethical view of the world? What are the types of things that you want to find in a portfolio that you don't want to find in a portfolio? What climate impact do you don't want to have? And increasingly, they'll discuss that from the perspective of a fundamental return requirement of your portfolio. Because increasingly, you're going to see that the firms that are good at this type of stuff, the firms that are making an impact from a carbon perspective, are going to be the successful firms going forward. It's becoming ever more an important part of a key investment decision about investment returns, rather than something that's going to get you less investment return but make you feel better. So I would urge you, if you don't have one, to get out there and work with a good financial advisor on all of this, because the processes, the procedures, the technologies that they've got are there. They're there because the regulation's making them do it, not because the demand is there. But the plumbing is starting to be there, so I'd urge you to all go and make use of that, ideally, at the end of the line.
Yeah, do bring it up with your advisor. I regularly hear that people don't ask, and then I tell advisors that you don't really expect clients to tell you what they want, because if they did, they wouldn't need an advisor. So completely endorse exactly what Dan's saying there, and they can now do it. There are ways, there are tools out there to help them. So I think, who did I have next? Mark. Perhaps an example asset type, if the case study, something like that you might want to talk around?
Yeah, sure. And I can maybe bring two just to show a little bit the nuances and diversity that we're managing in terms of companies. One is a company out from Germany, a leader in green hydrogen electrolyzer manufacturing. And obviously, as we heard already from Irina, they're really kind of now accelerated by a lot of positive tailwinds that we're seeing on the regulatory side, on the finance side, but also really on the ethical, moral, and the sustainability megatrend side. So very exciting business, have two technologies. They're very sophisticated in terms of full visibility on their carbon intensity of the product, and also obviously the baseline. The baseline is very easy actually to define because the EU defines exactly what green hydrogen is and what the carbon intensity needs to be there or below a certain threshold. So that makes our lives a little bit easier to also not only kind of capture really carbon emissions in scope 1, 2, 3, but also scope 4 avoided emissions for that company. And that's clearly one of the best, better cases in our portfolio. Another example, just to give you a really kind of completely different business, hospital chain in India, 12 hospitals in tier 2, tier 3 cities, 8,000 beds, providing really elementary and foundational healthcare to lower income population in India. Now, obviously, also they need to run their business and operations, and obviously struggle because they take electricity from the grid, which has a certain intensity, and they are reliant, actually, for example, on backup diesel generators if the grid is not delivering. And these are the challenges that these companies are facing, and that we're working together to try and solve them, and also decarbonize across the portfolio, not only for the climate solutions.
Of course, absolutely, and that, which is what needs doing, right? Duncan, perhaps, look, Sage must have bought your company because they thought it was an opportunity, right? They've got to think it's a growing area. Would you like to talk to us, maybe give an example of how you see it growing?
It is actually a very good introduction because before Sage bought Spherex, we were already working with NatWest, for whom we're now still working. We provide our carbon accounting calculation engine, provides the brains of Carbon Planner, which you can go and find on NatWest's website. The reason, well, I mean, don't want to speak for the reasons, but one of the reasons that NatWest developed Carbon Planner is because they're a signatory to PCAF, the Partnership for Carbon Accounting Financials, which was launched at COP26 by Mark Carney. There's now, among PCAF signatories, there are now, I think it's $87.5 trillion of assets under management. So for reference, global GDP was about $105 trillion, so a lot of money. And what PCAF obliges you to do when you're a signatory is to increase the amount of money that you put towards green lending and to improve the measurement of that lending and to improve the reporting of that lending. So just within the UK, the figures are roughly right. NatWest has, I think, about 6 million business customers, that neck of the woods. Each of those business customers can use Carbon Planner and they can do their carbon footprint. That then automatically links into a bunch of mitigation actions. I mean, the obvious things, solar panels, EVs, heat pumps, that kind of stuff. And then that streamlines the lending process with NatWest so that they can then afford to reduce the cost of lending that money. So they're improving, they're making it more efficient to lend green. They're automating the process of monitoring and measuring that lending, and they're automating the process of reporting, which, even for NatWest, obviously they've got millions of customers. It's just not practical to do that by hand. You can't do it. Yeah. And if you then extrapolate that around the world to all the other PCAF signatories, obviously that can't be done by hand. It doesn't scale. So you have to have an automated system like this, which is what we've developed.
And it feeds through to the company's bottom line if it's helping their interest rates.
Absolutely.
And you've got the financial incentive mechanism.
Yeah, and then say you've the figures have showed that a company, whatever, needs a heat pump. You can do the cost benefit analysis, and then you can track how effective it was as well, because they keep using the system.
Cool. Irina, can I please ask you to touch just briefly on I think it was a company you wanted to talk about, companies.
I have 3 points to make. Number one, data for data has no value. Unless you utilize data for value creation and operating model changes, data that just sits in spreadsheets. So typically, our partners develops impact performance plans for each business within our portfolio. So by Q1 of each year, we'll have an impact performance plan that we leverage the data for specific operating model changes. Number two, just quantifying emissions footprint is not enough. We go one step further and we look at emissions reduction potential to capital invested, emissions reduction potential to equity value, as well as impact on EBITDA. These are projections that are still very hard to make, but this is the next step where the industry needs to go. So just talking about emissions and not looking into correlation to financial performance, I think is a little short-sighted. And I want to share a specific example. I want to highlight another portfolio company, which is called Continuum. It's a business that takes scrap metal and atomizes the scrap metal and produces metal, which obviously displaces virgin metal. So there is a high ERP based on that, and that metal powder is utilized for 3D printing in different technologies. And so this business executed a life cycle assessment, so product carbon intensity analysis, took the data insights from that analysis and executed operating model changes, such as 100% of renewable energy procurement, swapping of specific suppliers within the supply chain, which had reduced the essentially emissions of the product line, and of course fed into customer value proposition and the offtakes that the business is having, and typically having positive impact on their financial performance.
Brilliant, thank you very much, that's wonderful. So my last question was going to be around AI, and I'm really hoping that as we started a little late that we'll be able to finish a little bit late, and that gives us a good 10 minutes for questions. But if I could just ask, I'm going to start with, if I may, Duncan and Dan on AI, as you're more on the tech side, but just briefly, I mean, AI, massive environmental impact, and clearly it's got overlap with financial worlds, etc. Any thoughts?
Yeah, one of the great advantages of now being part of Sage is that Sage has its own AI lab. So because we're trying to automate everything, we have a bunch of data which companies already have, accounting data, banking data, that sort of thing. And that data has a lot of metadata associated with it. So if you have a transaction, we can see what region you're in, when the transaction, if the transaction was at Christmas time, we can see the scale of the transaction, we can see what nominal code you've apportioned to it, what the merchant was, all of this sort of stuff. And this is just perfect for, it's not artificial intelligence, it's machine learning, but it's perfect for that sort of thing. That you can then say, right, okay, match that up, tell me what that is, so that I can tell you what emissions factor is attributed to that. And when you get really big data sets, which we really, even with Sage Business Cloud Accounting, our smallest accounting package, we have transactions in the billions. You have to book compute time to be able to do this stuff. It's really big. But with those kind of data sets, we can see insights into what these transactions are, which gives us an enormous advantage in automatically being able to match those transactions. And we also do things like bringing in more data sets. So we're working with, I don't know how many of these organizations you're familiar with, but Bankers for Net Zero contracted a firm called Icebreaker One to do Project Perseus. Project Perseus is doing for emissions data, climate impact data, what open banking did for financial data. So a trust network which automates all of that flow of information. So something like Sage Earth, where before we would pick up, say, a monthly bill, now we have half-hourly meter readings in real time coming into the system. And you can feed that to the AI, see what the trends are, see what the weather is, that sort of thing. So you can do amazing things with these vast quantities of data.
Wonderful, thank you. Dan?
Well, Mark, Arena and Sandeep have all been talking about some of the great things that they're investing in. We're investing in this company that does that and this one that does the other. And I'm sitting here going, I'd quite like some of that. These all sound really good. The issue ends up being how do I go and get it and where do I find it? The AI will have a role in in just scale machine reading of information to be able to populate that information flow that we talked about that needs to happen. It's as simple as that, really. I don't see that there is some utopian future where everybody here is logging on and speaking to an avatar they're going to intrinsically trust and then invest with. But the processes that are used by the component players in the marketplace should end up with information being read, categorized and used more readily. That means that end consumer over there and that company over there can be matched up more easily by those fund managers and those guys in the middle.
Although I would add to that I think it's got massive potential, and clearly it's something that's going to grow, isn't it?
Oh yeah, huge. Yeah, I mean, I'll give you some practical examples, not in the sort of carbon space, but in the day-to-day space that everybody here will interact with. There are insurance companies out there that have taken their ability to settle a car insurance claim down from 4 weeks to 4 seconds using AI.
Oh, good grief.
Simply because their systems are now able to machine read hundreds of pages of contracts and documentation going back years and years and years, and then looking at the incident documentation and any police report, and it just says, nothing to see here. It is not worth the time or the effort to do anything other than pay that claim right now.
Fantastic. I mean, all with a big carbon footprint, and that all needs managing, but what a great service.
Yeah.
Thank you. So, Mark, briefly, please.
Maybe coming from, again, investment perspective, I think all of our companies are data-driven, tech-enabled. That's clear. Many of our companies use AI in one form or another. It's clearly the key lever actually to drive down transaction costs, delivery costs, which actually on the impact side usually increases affordability and access. So it's a great thing. That's actually what we like to see. There's a lot of opportunity there. We're also aware of the risks with that, because if we talk about tech and AI, it's a neutral tool. It's a means to an end, right? It can be deployed in different ways. So we've actually, for example, started to formalize a tool, an AI assessment tool, to really also make sure that we understand exactly how AI is being used in our companies. And also that extends, for example, into cybersecurity, which we believe is more and more also equally an opportunity and a risk. So there is a lot happening. Also, for example, on the third-party services side, when it comes to data modeling, etc., that we're leveraging and piloting and testing, there is a lot happening at the moment there, which excites us, but also with the needed caution to really be sure we have our risks under control.
Thank you. Irina?
I want to highlight the different side of this equation. We all agree this will be very impactful, and we're looking how to leverage AI. But what's interesting is that AI query compared to a Google search is 10 times more energy intensive. So there was a recent Goldman Sachs report that was published in May, which stated that power demand because of AI will increase 160%. And this is changing the grid profile. So in US, we expect that 9% of entire power demand is to come from data centers. And so we internally think about the investable market and what are the opportunities that allow us to leverage different technologies, be it for data center cooling or different types of investments that can essentially attack or address the demand, so grid services, solutions, etc. So I think it's also an interesting investable opportunity in real economy beyond the SaaS sector.
Thank you. Randeep, please.
So I'm going to make two very brief points here. The one area that AI can really help from a societal perspective, much like Dan touched on with insurance, is healthcare. Growing population, aging, just in terms of diagnostics, understanding treatments, AI can really, really ramp up what we can do there and bring costs down to make healthcare much more affordable and much more open to wider population sets. Now, just touching on what Irina said there about data, yes, the quantity and the use of data is going to continue to grow. That's going to require a lot more energy. But remember also, the large data center providers in the world today, the AWS, Microsoft's Azure, Google, are also the biggest underwriters of PPAs. For renewables to take off, we need greater scale in order to get the costs down. although this is going to put more of a demand on the grid, it actually provides the long-term funding that you need for on and offshore wind, for solar projects to really, really kick off and to continue to get those costs down. So while we're looking at it in the immediacy today of, oh my God, there's going to be even more electricity demand that is needed, what you're actually going to find, and I think what we're starting to see now, as this demand grows, it's renewables that continue to take up the slack. The economies grow, the prices come down, and it becomes a virtuous cycle of their production increasing.
Fantastic, thank you. Yeah, pros and cons, and hopefully self-fulfilling and moving forwards. Can I now, in the last 5 minutes, ask if we can turn to questions, please? We've covered a lot of really diverse areas. Are there any questions from the audience? Please, somebody kick off. I have no planted questions, just so you say. Didn't occur to me until about 1 second ago. Thank you.
Yeah, my question was about Article 9. It was mentioned a few times, and I don't know what that is. So
you don't know what it is?
Explain on that would be great.
Sorry. I'm such a geek. I'm so sorry. Would anyone like to explain what Article 9 is, or shall I jump in, please? So Article 9 is EU classification of funds under SFDR, Sustainable Finance Disclosure Regime. Launched a few years ago. Europe was ahead of the UK on it. And basically it's funds with the highest sustainability standards, effectively. It's being used as a label, but it was meant to be a technical classification system, so they're rethinking it at the moment. But a good thing to help people find good funds, basically. I'm so sorry, that was ages ago. You should have waved at me. But please, any other questions?
You mentioned several times. Sorry, hi, I'm Mauro from Agrina. You mentioned several times kind of new industries like hydrogen or others that are kind of, in a way, long-term things that could or not happen depending on regulation, on incentives, no? In those cases, on all these new industries, when you invest in them, how do you assess that? Like, you just assume, okay, eventually the government will subsidize hydrogen or subsidize mycelium for building new materials, it's a bet on those things, or you have some kind of way of seeing, okay, this regulation is coming. If it's not coming in 2 years, it will come in 5, or eventually it will be a carbon tax. How you assess those opportunities?
How do you assess an investment opportunity? Let's go for the investors here.
Sure.
We've got 3. So
maybe I can start off with that. So if you take the hydrogen opportunity, for example, I mean, it exists today, that just that the costs are so high. Exactly the same place something like solar was or wind was a long time ago. There are certain industries that are so hard to abate that you're going to require that. They're not going to be able to move to electrification, especially when it comes to transportation. Now, what President Biden's done in the US with first the Infrastructure Act and then the IRA, the Inflation Reduction Act, is actually changed the US tax code. So rather than providing a direct subsidy, he's incentivized companies to do this via the tax code and written it into law over a 10-year period. So, and it's been written into a way to make those projects, if you invest today, cost effective, that the US will give you a tax allowance over those 10 years for your business. So you can see clearly now that even though it's not economical today, by putting the investment in, you don't have to pay the taxation on it, you get a tax break, and over the more and more investments you see, like we've seen with solar, like we've seen with wind, those costs should begin to come down. So you need to put the pieces together. What's the problem? What's the solution? It's not economic yet. What, for example, does a government incentivize you to do, and for over what period of time? And once you put that together, you can make the investment case.
Thank you. Arina?
I would say we have specific investment criteria. We don't take technology risk. We don't invest in science projects. We see this more for VC asset class. We look for an existing offtake agreement, existing commercial facility, positive cash flow, and we're looking at scaling the business. And for right-sizing the market, we typically execute market studies to see where the market is going, to inform our perspective. And then I would also say that ARA has a technical expertise in the sectors in which we invest. We are specialist investor. We have a separate team called ARA Portfolio Services that also helps to scale businesses, so EPC contracting, facility scale-up, capital project delivery. So we are built to essentially scale companies in technologies that we see promising.
No, very similar, actually, to what Irina said. That covers it well.
Thank you. Can I ask for one final question before we wrap up, please? Are there any final questions? I think all of us will be here for a few minutes after the session, so you are very welcome to come and talk to us if you don't want to pop your hand up. Over there. Sorry, the lighting makes it quite hard to see the audience.
Hi, sorry. It's actually sort of not a question, it's kind of like, because I want to be on Team Duncan, really. So, environmental lawyer here. I just wanted to leave everyone with that kind of final reminder. I'm really excited to see that, finance is getting on board, and we can't do this without them, obviously, this world. But the thought I want to just put everybody's mind just before they kind of leave the room is not to forget that we are part of nature, and not the other way round. And it kind of doesn't really matter what we do in life. I live in Kenya, by the way. So every day I live in a world where there are droughts and floods all the time. And my friends try to, run their businesses and live their lives. And the people who are around me all the time are struggling to live. And so we live in this incredibly privileged, lucky first world. But it doesn't really matter what we do in life. We all need clean air and plastic-free water. So kind of ideally you get up every day and say, okay, brilliant, I've got a really cool investment business, but what am I doing for the world today? Because it's my children and my life and my grandchildren's life, and we all have to, breathe the clean air every day.
Which is all deeply personal. Look, I think that's a fantastic note to end on. Would anyone, sorry, you wanting to come in on that?
I was just going to come back with, and I won't say who, but one of the banks that we were in a meeting with. There's this guy who had been there for obviously some time, and we were talking about sustainable finance, and he just burst out, I hate this expression, sustainable finance. What are you saying? All the stuff we've been doing up till now has been unsustainable. Finally, you get it. Yes.
Yeah, sometimes I show a slide with a picture of a planet on it saying not sustainable is not sustainable. It's just get your head around that, guys. Look, given the time, I think probably if anyone wants to say any final things that you think that's massive that's missing, otherwise I will close. Are we happy to close? Right, in which case I would like to ask you to thank the panel in the usual way. Thank you. Fantastic work, guys. I really enjoyed that session. I had no idea how it was going to go. But we covered some really interesting and diverse ground and getting you a picture of the puzzle that we've got to solve and all these different moving parts. So thank you for joining us. Thank you for being with us. I hope you found it useful. Please come and talk to us after the session if you would like to. Thank you. Bye-bye.